Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Today I wanted to start the week off by giving investors something to think about. 5 stocks, including a couple of household names, a couple of surprises that might be worth a look. Remember, this is general information only and you should seek professional advice before making investment decisions. Grady Wulff is a market analyst at trading platform Bell Direct, part of the ASX-listed Bell Financial Group. Grady, welcome back to Fear and Greed.
Thanks for having me, Sean.
Righto, 5 stocks to go through. I'm going to start with one which I know nothing about. The 5 you've sent through, 4 of the 5 I kind of know a fair bit about. One I know nothing about, DroneShield. Tell me about it.
DroneShield's an exciting one. Well, given around the world, we have rising geopolitical tensions, which includes war and escalating war between different countries, which is obviously devastating. But DroneShield's a company that's come onto our radar over the last few years because of what they're doing in the drone and anti-drone space. So they're not actually there to help with terrorism or anything or help with any of the wars. They're actually there to take down the threats of autonomous vehicles like drones and different autonomous weapons that countries are using these days in the wars. So it's actually a safety technology platform, and they've got both software and hardware, and it's a really, really exciting company emerging in this space. Now, they've really come to our forefront because they have a pipeline of sales and a lot of contracts with different government departments that's really putting them on the up and a really long growth runway for a company like this with revenue. There's not many competitors in the space, which we like to see, obviously, with such a niche product, but countries around the world are definitely increasing their spend on the defense front, and DroneShield has really capitalized on that. So they have about $510 million in sales pipeline over the next few years, with 388 of that in CY24. So that's a very strong result for a company that is out there in the defense space. And what we also like is the fact that the company is now profitable. So this is their first year of profitability. So with a company that any company, especially in the tech space, you want to know they're profitable, it's exactly what DroneShield has achieved this year. So we have a buy rating on that with a 12-month price target of 90 cents per share.
Okay, so once you started talking, I thought, actually, I do know this company. I'm trying to remember, is it a US company? I mean, and I know it's listed here.
I think it was founded in the US in 2014 or 17. Right. And the CEO, Oleg Vornik, I interviewed him a little while ago, and he's an awesome guy, and he's just so passionate about what he does and the constant need to keep updating technology so they can respond and take down these threats of autonomous defense mechanisms.
Yeah, we've had Olive on the show ourselves. That's why we're so familiar. Awesome. He's a real enthusiast. The next stock I want to look at is one that I use because I have teenage children, Life360.
Yes, so Life360 has been on my radar for a very long time, and it's one that's quite contentious in the market because it hasn't made profit just yet over a full year, but we're so excited to see how much the company has grown over the last few years. So a company in the tech sector, especially offering a service for free as this company, as Life360 did initially, it's really hard to implement prices and to convince the market that you're worthy of their money. But they successfully did this and not only implemented prices, but raised prices in 2023. And what that goes to show is that everyone around the world loves their product. And their recent market update included global monthly active users increasing 4.9 million to 66.4 million people. So everyone around the world is using Life360. I know a lot of people at my work do, and I know you do as well. So tracking your kids has never been easier. But also they have the physical, the tiles, which is their hardware part of the company. It's a competitor to Apple's AirTag. So this just goes to show that they're really making their mark in the geolocation space. They have had, I think it's 3 consecutive quarters of profitability. So with that in mind, we're definitely very bullish on Life360. And their paying circles as well has increased 96,000 to 1.9 million in the most recent trading update. So what that says to us is that their people are more willing to pay for their products. So with a tech company that's verging on profitability for a year, we're so excited.
What should I be paying for with Life360? So all I do with Life360 is just check out where my kids are. Where's the revenue stream in it?
The subscription model. So there's different tiers that you can access. You can access different features through the model. You can talk to people. There's different incentives to get you into the subscription model. So I know a lot of people are really liking it. And obviously with growing global monthly active users and growing paying circles, it goes to show that everyone is welcoming of the prices they have to pay.
Stay with me, Grady. We'll be back in a minute. I'm speaking to Grady Wulff, market analyst at Bell Direct. Paladin Energy, that's the next one, a uranium play, always going to be controversial. Why do you like that one?
Yeah, it is a controversial one, but it's one that's really come onto our radar, especially in the last year. And we covered 2 uranium stocks, so Boss Energy and Paladin Energy. And we really like them because, again, this global push to the green energy transition cannot be done without uranium. And I know there's a lot of controversy around nuclear power. It needs uranium, and even countries like Japan, where the Fukushima incident happened, which was devastating, they're turning their nuclear power plants back on because we need this nuclear power as part of an energy source and power source moving forward. And the green energy transition can't happen without uranium. So with that in mind, we have Paladin Energy with a buy rating at the moment and a price target of $1.65 for the next 12 months. And the company has just this week announced their first production of uranium drums at the Langer Heinrich mine in Namibia. Now, the thing about this mine, it's a proven operation. It was just put on mothballs since 2018 because the price of uranium went so low. And so what that says to us is that it has a track record of producing. It's able to be produced. They have the restart operation. It's up and running now. We've got production, which means a good streamlined cash flow. And we've got clear cash flow view coming through. And so once a company, and mining company especially, is making money, investors are very welcoming of this. And so what we also like is more recently, the company has been progressing through recapitalization, paying down its debt and balance sheet, and to stabilize its balance sheet under a new CEO, which is Ian Purdy. So we're really, really bullish on this company. The outlook is strong. It's in the right place at the right time. Uranium is soaring right now. I think it's up 88% or something over the last year in price. And so that just goes to show that uranium really is the commodity of the moment and puts companies like Boss and Paladin on a really, really positive scale for investors.
Okay, Woolies. We all know Woolies. Been in the limelight a fair bit too, and the grocery inquiry started last week, continuing this week. We're expecting to hear from the bosses of Woolies and Coles this week. I actually feel sorry for the retailers personally because I think they're doing great. Right, there you go. Grady, we're on the same page here. Why do you like Woolies as an investment?
See, I love Woolies. I had to actually do a case study on it for a university course in my postgrad because I just last year. And Woolies actually, it's really interesting to see that ACCC is going after Woolies and Coles for price gouging, but because Woolies' profit margin has actually come down in the last year. So I'm not sure how they can claim that they're price gouging where their profit margin is coming down. So they're not shooting the lights out of prices. They're literally just trying to make profit. And that's what every company does, and investors are very welcoming of that. So naturally, with the news and noise, the share prices come under pressure recently, so it's down 15% over the last year, but that's truly a buy-in opportunity and a lot of the brokers agree. A lot of brokers have slapped a buy rating on Woolworths because the company is Australia's biggest and leading supermarket giant. It has 38% of the market share, and Coles is behind that. So it goes to show everyone trusts Woolies, and Woolies is the number one in Australia. There's no denying that. They've also got really good sales results. They've got a really conservative debt level, and they really tick my boxes personally on an ESG front. And I know ESG is quite a controversial thing to talk about because there's no regulations, there's no rules, there's no guidelines. You don't have to do it. But Woolworths have taken the initiative to not only take their whole fleet of petrol vans to EV battery vans, they've got a mini Woolies program which employs disabled people to get them into the Woolworths employment system. They have a lot of different initiatives out there, and I really, really like the fact that they are all about ESG. And I really also, and investors welcome the fact that they demerged their alcohol and tobacco assets through the demerger of Endeavour, and that's really proven positive and really put Woolworths on the forefront of different fund managers' minds because who previously wouldn't look at Woolies because they had an association to alcohol and tobacco. So in all, for me, I love the company. They've done such a good thing recently. And they've also just expanded into pet retail. Not sure about you, but a lot of my friends got pets during COVID and they spend so much money on pet retail, and the margins in pet retail are huge. So that's a really strategic and really successful expansion for Woolworths.
Talking about pets, kind of, not really. Ingham's. Chickens. It's probably fair to say they're certainly not pets at Ingham's. Tell me about Ingham's, though.
Well, my sister has pet chickens, so they could be pets. But no, Ingham's Chicken is, we've got a buy rating on Ingham's Chicken recently and a price target of $4.35 simply because of a few drivers and a few tailwinds we see emerging in this industry. Now, obviously, Ingham's is Australia's largest poultry producer. They have contracts with the biggest supermarkets like Coles and Woolies, and I'm sure any chicken you eat is mostly going to be an Ingham's Chicken. And they obviously sell their eggs as well. So the company's done really well. Obviously, it's kind of like an agricultural business where you do have to go through the cycles of inflation with feed prices, but we're actually seeing feed prices have come down over the last year, and we're expecting them to stay down over the coming years. Now, Inghams have a forward purchasing agreement, so they lock in their purchasing agreements, and they locked them in at quite a high price recently with the idea in mind that their costs would be high. They're actually coming down, so that it really makes way for profit margin to come through. So we really like that. We also see that the price of chickens are going up and the volumes that they're producing are going up. And it's really interesting with chicken because last year we had a hold rating on Inghams because beef and lamb prices came down, but chicken prices went up. And so demand naturally shifted to beef and lamb. But now we're seeing chicken prices moderate a bit more. And so people are turning back to chicken. So it's a really interesting seesaw there, but I'm not sure why it happens. But I think everyone, with the high cost of living pressures we have at the moment, they're looking for the best alternative and any alternative for protein. So chicken is the word right now.
Chicken's the way to go. Grady, that's fantastic. Of course, you've given us 5 stocks here that you like: Drone Shield, Life 360, Paladin Energy, Woolies and Inghams. But of course, if you are listening and you're going to invest, you need to go to a professional advisor to suit your own circumstances. And Grady, I'm sure you agree, there is no such thing as a sure thing in investing.
Absolutely not.
So it kind of looks at the pluses and minuses. But thank you for talking to Fear and Greed.
Thanks for having me on the show.
That was Bell Direct Market Analyst Grady Wulff. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.